Hi, I'm Jules and you're watching Catalyst Plus TV, the place to be to make more possible. Today we're continuing the tax time conversation, and I know it's still not the most exciting subject, but it is something that we all need to do. Now this week's topic is especially important if you have an investment property. In addition to all the things that you need to bring with you to get your tax return done that we talked about in last week's episode, you'll also need to bring a few things with you to ensure that you're claiming the right amount of deductions. The first thing to bring is the statement from your real estate agent. They should be able to provide an annual statement of all the rent that they've collected on your behalf, all of their management fees, advertising and expenditure, and if you've allowed them to pay your repairs and maintenance along the way, then that as well. So that statement is important for the basis of your deduction. The second most important thing that you need to bring with you is your bank statements for the mortgage that you have over the asset. Now you'll need it for the whole 12-month period, and that's so that we can identify how much interest you've paid that is directly related to that investment property. The third thing you'll need to bring with you is any other repairs and maintenance documents and receipts that you've got. And that's if you've done a little bit of repairs and maintenance or some renovations without the property manager. What other deductions can you have though? A lot of people don't actually understand they can claim a depreciation on the actual asset, being the house, the property, or the apartment that they've invested in. Things like the kitchen, the bathroom, any renovations that you may or may not have performed. In order to claim a deduction that is correct, we often advise people to go and get a registered conveyancer to do that. There are some specialists out there, and we'll put a couple of links below on this blog. Another thing that you might want to look into is whether or not you've purchased the investment property in the current year or sold an investment property in the current year. In both cases, you'll need to bring the contract of sale with you to your tax advisor so that they can make the right capital gains adjustments. So remember, every time you claim more than $300 in deductions in your personal tax return, you must keep those receipts for 5 years. We recommend that you take a scanned copy of those so that you've got an electronic copy of it, just in case something happens to the physical receipts. So that's about it. If you've got yourself an investment property, make sure that you download our checklist below at www.catalystplus.com.au, and then you'll be able to ensure that you've got the whole list of everything that you might be able to claim. But in any case, remember, this is general information. It's not specific to your situation, and for that you'll have to get specific tax advice from your tax advisor. In the meantime, have yourself a great week, and we'll see you in next week's episode of Catalyst Plus TV.